Welcome to the Wavy Tunnel Plus, the Elliott Wave Ultimate version of the original Wavy Tunnel methodology. In this version, we fine-tune the Wavy Tunnel trades and provide new and fresh examples to illustrate these trading setups. Once you learn these setups, we go one step further and add harmonic chart patterns to the Wavy Tunnel setups. Welcome to the Wavy Tunnel Plus trading methodology. Thank you for taking the time to learn about a system which is timeless, applies to all traded markets and every market cycle. My name is Jody Samuels, trader and coach for FXTradersEdge.com, and together we will explore a system that was formulated in 2006 by a few colleagues of mine just having fun, combining indicators to create strategies for traders. At the time, they didn't have the Elliott Wave background, so when I saw the Wavy Tunnel chart setup, I immediately recognized that this was an Elliott Wave setup that would apply to the high probability Elliott Wave trades. And so began my journey to teach other traders about Elliott Wave analysis so that they could use Elliott Wave analysis as a top-down approach in their trading. And what was the strategy that we worked with? The Wavy Tunnel. In the original Wavy Tunnel modules, we taught 5 trade setups. In Wavy Tunnel Plus, we teach 6 trade setups, as we have added the breakout 4. I am very thankful that I can teach you a system that is tried and true and that has weathered many different market cycles and traded instruments, including currencies, commodities, and stocks. About myself, I have over 30 years experience trading Forex futures and options using Elliott Wave analysis. I can honestly say that the Wavy Tunnel is one of the best Fibonacci and Elliott Wave-based trading systems that I've ever used. Whether you are a day trader or a swing trader, you are in for a real treat with this video series. And with our help and support, it is my hope that it transforms your trading forever. In the Wavy Tunnel series, the modules that we will cover include Module 1, Introduction and Overview. We are in that module right now. Module 2, Trend Following Trades. There are 4 of these trades that will be illustrated. The breakouts 1, 2, 3, and 4. Module 3, End of Trend Trades. There are 2 of these trades that will be illustrated, and all of the examples are new for all of these Wavy Tunnel setups. Module 4, Trade Management, where we introduce the 3 profiteers, a wonderful way to capture profits without giving any back. Module 5, Trading Live, where we show you live trading setups with entries and exits. Module 6, Elliott Wave Connection, where we show the wave counts along with the Wavy Tunnel setup so that you can see how easy it is to spot the patterns without actually labeling the waves. And finally, Module 7, which is a completely new module called Wavy Tunnel Plus. It includes the Bungee Plus, semaphores, Forex calcs, and more on divergence. P.S. The trading room uses these indicators and tools to pinpoint trend and end-of-trend moves in conjunction with the Wavy Tunnel. Learn how to use these tools to complement the Wavy Tunnel setup, i.e. Wavy Tunnel Plus. In this module, Module 1, the learning objects that we will cover include an introduction, a definition of what it means to trade market cycles, the Wavy Tunnel chart setup. Finally, we will do an overview of the 6 Wavy Tunnel trade setups that you will be focusing on in this video series. In this module, you will leave understanding the background and thinking behind the Wavy Tunnel. Why does it work so well? We will start by reviewing the market cycles to see how the Wavy Tunnel tracks the cycles and waves, trends and sideways corrections. You will get a broad overview of all 6 Wavy Tunnel trades and how they apply to the 2 predominant market cycles, trends and corrections. Please begin by picturing yourself riding the waves and cashing in on profits using the Wavy Tunnel Plus system. Just so that we are all on the same page, if you are viewing this video series, you have taken some form of basic technical analysis training, and you have also just completed the Elliott Wave series. In most technical analysis training courses, you learn to identify and name the market cycles. The market cycles are typically called trends and sideways markets. You then begin to understand that each cycle requires a different strategy and mindset. Once the cycle is identified, you learn which strategies to use to trade each cycle. For example, moving averages work really well to stay with the trend, and oscillators are great for sideways markets and to find divergence as in the end of the trend. All of the analysis tools learned are combined to create high probability trading strategies. But without Elliott wave analysis and harmonics, traders do not have the complete picture yet. In the Elliott wave series, we label these cycles and we call them waves. We learn about subwaves too. We learn how to find the end of the trend and what a trend, correction, and reversal pattern truly means in the context of the big picture. We learn that all trends are not created equal, that a wave 3 is more valuable than a wave 1, for example. We also learn about extended waves and how a wave 3 can go on and on. But the good news is we can count those subwaves and we know what to do when the wave moves from 5 subwaves to 9 to 13 and then to 17 if it is really extended. If you don't recall this discussion, please review Module 2 of the Elliott Wave series along with the coaching session that accompanies it. We also learn all about the awesome oscillator and its power in determining the end of a 5-wave sequence so that we are ready for the correction. Finally, we bring it all together and introduce a powerful trading strategy which addresses all market cycles, the Wavy Tunnel. Today, we bring you the Wavy Tunnel Plus as a standalone video series. So, if you have your basic training hat on and your Elliott Wave knowledge in hand, you are ready to begin this journey. The more experienced a trader you are, the more you will see and understand the value that the Wavy Tunnel trading methodology adds to your current trading system arsenal. Once we learn how harmonic patterns complement Elliott Wave analysis, we will then revisit the Wavy Tunnel and tie it all together. Let's begin by reviewing the market cycle. In the 5-wave market cycle, point 0 is the start of the move, and wave 5 is the final advance to point T, the termination point. In commodity bull markets, wave 5 is often characterized by explosive blow-offs, but in currencies and stocks, they are usually not. In currencies and stocks, wave 3 is usually the strongest move with the steepest slope. Wave 5 is the trader's last struggle to create new high prices. It is not as enthusiastic or euphoric as wave 3. Momentum divergences are evident as the momentum slows, since it is the end of a 5-wave sequence. Optimism continues, and this is the best time not to be part of the optimistic herd mentality. In the currency markets, 5th wave failures are often present, as the 5th wave fails to make a new high above wave 3 because there are too many participants and traders looking for that last move up, that last gasp. One way to target the end of wave 5 is to measure the difference in price between the start of wave 1 and the end of wave 1. Then add this measurement to the bottom of wave 4. If wave 3 is the longest wave, this usually provides a good approximation for the wave 5 target. And then, when you see divergence between wave 3 and wave 5 with the awesome oscillator, you can get a more precise profit-taking target to retire the long positions and a new trade entry point for a short position. The FX Trader's Edge trained trader uses tools to play pullbacks, breakouts, and breakdowns during trend moves. All traded instruments move in cycles. At each point in the cycle, the instrument either moves up, down, or sideways. 3 types of strategies are used. 1. End of trend strategies at market tops and bottoms. Learn how to buy and sell at market tops and bottoms in any time frame. 2. Sideways strategies for waves 2, 4, and B include range trades and looking for breakouts and breakdowns, setting up for a continuation of the trend. Waves 2, 4, and B are merely pauses in the trend. 3. Trend continuation strategies for waves 1, 3, 5, A, and C. Momentum trades fall into this category. Breakout and breakdown trades do as well. And so do retracement trades. All of these types of trades have one thing in common. They get you into the trend. Where they differ is at which point you get in. For example, a momentum or scalper trader captures very small price movements, so will look to get in and out along the curve. A breakout trade, in the case of an uptrend, gets you in the direction of the trend once it breaks out of its consolidation trading range. A breakdown trade is the same trade, but in the case of a downtrend. Finally, a retracement trade gets you in earlier than a breakout trade. Once price corrects, you can place an entry order. And this is where Fibonacci really comes in handy as well. These are really 3 different entry methodologies to ride the trend continuation strategy. In this Wavy Tunnel Plus video series, the 6 trading setups will get you in at the end of the trend and during the trend. They are very defined and clear setups. In other words, the Wavy Tunnel captures all of these strategies. Let's begin to unravel the mystery behind the Wavy Tunnel. What exactly is the Wavy Tunnel strategy? Simply put, it's a moving average crossover system. It combines the Vegas tunnel, which we call the tunnel, and the Raggy Wave, which we call the wave, with Bill Williams' awesome oscillator, the CAO. The chart setup provides excellent entry and exit points and is visually appealing. It is ideal for day, swing, and position trading by using different time frames. When used with an Elliott wave overlay for confirmation, the system is very powerful, and the Wavy Tunnel system has evolved over time to produce 6 high probability tradable setups with individual trade plans. These setups have been observed and traded over many years, and the system remains robust no matter what time frame or instrument is traded. The setups, which you are about to learn, can be used on any time frame from the monthly on down to a tick chart. Once we get into the Trading Live module, you will see what I mean. The key elements of the Wavy Tunnel chart setup include the moving averages, which include the tunnel, the wave, and the 12-period EMA filter, or the 12 EMA, and the awesome oscillator, or the CAO. In Module 7, when we learn the Wavy Tunnel Plus setup, we will include the bungee. You can think of the tunnel as the long-term moving average, the wave as the medium-term moving average, and the filter as the short-term moving average. You will learn that it is similar to a moving average crossover type system, only the averages are very tuned to Elliott wave turning points because the averages are all Fibonacci sequence based. Swing time frames include the 4-hour, the 1-hour, and the 15-minute. Day trading time frames include the 1-hour, the 15-minute, and the 5-minute. Some of you might want to use the 15, the 5, and the 1 and take trades off of the 5 or the 1-minute charts. You can take trades off the middle time frame or the lower time frame. Moving to a higher time frame reduces some of the noise which can get in the way of taking clean trades. We will learn this top-down approach of trading using 3 different time frames. The Wavy Tunnel chart setup includes the following EMAs: 12, 34, 144, and 169. That's all. Set up the wave on the 4-hour, the 1-hour, and the 15-minute time frames for swing trading. You will be setting up 3 different 34-period exponential moving averages, EMAs. These are the averages of the candlestick highs, closes, and lows. For the tunnel, you will also be setting up 3 exponential moving averages: the fast, or the 144, the slow, or the 169, and the fastest, which is the 12 EMA filter. It is recommended that you set up a template within your trading platform and call it the Wavy Tunnel. That way you can produce the template for every time frame or market you plan to trade using the wavy tunnel system. Notice the last column where it says Awesome Oscillator. The Awesome Oscillator, also known as the CAO, which stands for Chaos Awesome Oscillator, uses the 5-34-5 simple moving average, where the third 5 is the signal line on the histogram. It is a MACD histogram, so a 5-34-5 MACD is similar, but you must make it a histogram. Note, the wave and the tunnel are separate tradable strategies that have been combined into one strategy to create potentially higher probability and visually appealing trades. Swing traders will use the template on the 4-hour, the 1-hour, and the 15-minute charts. Day traders will use the wavy tunnel template on the 1-hour, 15-minute, and 5-minute charts, or the 15-minute, 5-minute, and 1-minute charts. This is the basic wavy tunnel chart setup. It looks like a moving average crossover system, with the 34-period moving averages as the shorter averages, and the 144 and the 169 period as the longer averages. You might ask, why not use a simple 200-period moving average for the long-term average in place of the tunnel? That would be a great question. What I have found from looking at thousands of charts is that the tunnel works very well in providing support and resistance. It is based on WD Gann and Fibonacci numbers. Gann looked at the interrelationship between time and price, square roots, and squares. 144 is a Fibonacci number in the Fibonacci sequence, and 12 is the square root of 144. The closest fib number to this square root in the sequence is 13. 13 squared is 169. That's the tunnel. If you look at the 1-hour charts in a trending market, most of the retracements pause at the tunnel before continuing the trend. Let's clarify our wavy tunnel setups by looking at the trend sequence once again. Wavy tunnel trades can be broken down into two types. 1, trend following, for which there are 4 setups, and 2, end of trend at point 0 and point T, for which there are 2 setups. Let's begin now to look at these setups. The trend following trades are called the breakout trades. Breakout 1, breakout 2, breakout 3, and breakout 4. Breakout trade 1 is when the wave crosses the tunnel. This is the first trade setup. The rules of this trade will be made known in Module 2. We will define how to get into the trade, where to set the stop, and where to take the profits. In this module, Module 1, we are just introducing the 6 trade setups produced by the wavy tunnel model. Breakout trade 2 is when the wave turns dramatically and leaves the tunnel behind. Said differently, the trend is down in this example, and price retraces to the tunnel as the wave and the tunnel come together. When price bounces off the tunnel and the wave separates from the tunnel, that is time to enter short in the case of a downtrend. That is the breakout 2. Notice that this trade is merely getting into the trend again after a correction. The correction could be a wave 2, 4, or B. The third trend following trade is called breakout trade 3. This is the most common because it is easier to spot. The wave crosses the tunnel initially, and then price retraces back to the wave. Candles form below the 12 EMA, and trades are taken as price bounces off the wave in the downtrend. The fourth and last trend following trade is called the breakout 4. This is similar to a wave 4 correcting to the tunnel. The wave crosses the tunnel, and wave 3 trades in a steep incline, in the case of an uptrend, or a decline in a downtrend, and price retraces back to the tunnel in a deeper correction. The candles close above the 12 EMA, and the trend continues. In this example, the trade is to buy at the wave 4 completion. The first wavy tunnel end of trend trade is called the price to wave trade, or the PW trade. When price is extended from the wave, and the awesome oscillator shows divergence between waves 3 and 5, a market reversal is imminent. The PW trade takes price back to the wave. It is a rubber band snapback trade, as price must snap back to the moving averages. Notice that we prefer that there is divergence before taking the PW trade. The second wavy tunnel end of trend trade is called the fill the gap trade, the FG. This is one of my personal favorites. After the PW trade completes at the wave, the market usually continues on to fill the gap. In Elliott wave terminology, this is usually the C wave back to the tunnel. The A wave is the first leg of the move back to the wave, followed by a sideways B wave and ending with a fill the gap C wave. Once the fill the gap completes, either price is going to continue to move lower in this example, or the breakout trades begin again when the wave crosses above the tunnel. If we are in a wave 3, for example, on the daily and the 4-hour, then a fill the gap trade to the tunnel will likely take us to new lows once complete. We will look at plenty of examples on how to integrate the wave counts with the wavy tunnel in subsequent modules. A guideline to use is to take the fill the gap trade when you see profit potential between the wave and the tunnel. In other words, make sure there is a gap to fill. In conclusion, we have 6 wavy tunnel trades, which we will go into much greater detail in the next modules. The 4 trend following trades include the breakout trades, breakouts 1, 2, 3, and 4. And the breakout trades, as it happened, can correspond to the equivalent waves. So the breakout 1 is typically the start of the wave 1. The breakout 2 is typically the wave 2 pullback of the wave 1. The breakout 3 is the steepest trend trade, where price bounces off either the filter or the wave. And the breakout 4 is typically the wave 4 correction, which takes price back to the tunnel. It's a deeper correction than back to the wave. And the 2 end of the trend trades include the PW and the fill the gap. In summary, why does the wavy tunnel use 6 trades? Well, the market offers different trading opportunities depending on what part of the market cycle or Elliott wave pattern we are in. The wavy tunnel trading tunes our visual sense to find the trend trades and the trend reversal trades. And finally, with the wavy tunnel, traders will be able to profit no matter what part of the market cycle we are in. What is required to succeed with the wavy tunnel? Mastery of at least 2 of the wavy tunnel setups. Don't try to learn them all. You will in time, but master at least 2 of them. Start with 1. Consistency with the time frames traded, day or swing or both. If you're a day trader, stick with trading the wavy tunnel on day trading time frames. If you're a swing trader, stick with swing. Proper risk management. That's all about setting stop losses. Good money management. That helps to determine the appropriate position size. We will discuss which wavy tunnel trades afford perhaps different position sizes. Excellent trade management, and that's all about taking profits and moving stops. This is what is required to succeed with the wavy tunnel. Are there specific rules to follow with the wavy tunnel? Absolutely. The wavy tunnel is a system which has rules. It's designed to be used by following the rules without emotion. Define the trade plan to avoid emotional trading. We will give you the trade plans for the wavy tunnel system. Most trades are unsuccessful when they don't have a trade plan or when the traders don't follow it. So learn the rules, follow the plan, and practice, practice, practice to internalize the wavy tunnel setups. Finally, How should I get started to build confidence with this method, you might ask? Find these trades over many days until you internalize the setup. And remember, pick one setup. You might want to start with the breakout 1 trades. Try to understand the theory behind the system. Why does it work? Why does it work so well with the Elliott wave counts? Take positions on a demo account or a paper trading account until a track record of successful trades is established. And then you can go live. Implement the method correctly. Do not guess where the market is headed until the setup takes you there. Let the wavy tunnel setup take you into your position. Do not think, just act in executing the trades. Mindset is really, really important. Think only at the end of the trading day or trading week when reviewing the setups taken. And finally, document every trade with a screen capture. See you in Module 2.